Hello and welcome to Value Research Helpline. I'm Ruchira and our experts here at Value Research are now all set to answer your queries on investing and personal finance. Joining us is Ashutosh Gupta, who heads the mutual fund research team at Value Research. Welcome, Ashutosh.
Thank you, Ruchira.
Today's first question has been sent in by Amar Shahani, who wants to know between a weekly and a monthly SIP, which do you think is better?
Well, I don't have, or I've not come across any empirical study which compares the two, but I'm pretty sure that if there were one that was done, then the results would be fairly random. There would be a high degree of randomness depending upon the time period that you choose, or even different schemes that you run such a study on. So I'd say that why overcomplicate things by going for a weekly SIP? Because in between a weekly and a monthly one, the weekly one would have 4 times more the number of transactions. You would have a much longer transaction statement to deal with. Even from a capital gains tax perspective, there would be a lot more transactions happening at different NAVs, so that complicates your capital gain tax computation a little bit when you redeem these investments. Now you could argue that all of that is handled digitally these days, but I'd still say why overcomplicate when there is no tangible benefit that you derive by making more frequent transactions of smaller amounts. On the contrary, we prefer to recommend monthly SIPs because it fits well with the cash flow cycles of most of the investors. So you earn monthly, and that's why you should save and invest also monthly. So for that reason, I'll suggest stick to the good old monthly SIPs.
All right, then Amar, you earn monthly, so you save and invest monthly. Now, Rajdeep Singh wants to exit from a fund downgraded from 4 to 3 star and reinvest in a 4 or 5 star fund. So should he exit in lump sum or through a systematic withdrawal plan?
Well, first of all, I like to point out to him that a downgrade from a 4-star to a 3-star should not be the sole reason for him to consider exiting from a fund. A rating of 3-star does not necessarily signify poor performance or a sustained underperformance. In fact, a lot of 3-star funds continue to be above average performers in their category. So I'd suggest that he should closely evaluate the reasons for him to consider exiting from this fund. That's number one. Now, coming to whether he should switch in lump sum or SWP, well, once he's made up his mind to switch out, then really there is no compulsion for him to do that systematically. But having said that, he should keep the loads and tax applicability in mind while doing that. And a better approach may be to shift in, let's say, 2 to 3 tranches. So immediately he should consider switching out of the portion which does not attract any exit loads, and where the capital gain tax accumulation is only up to a maximum of 1 lakh, so that he's able to benefit from the long-term capital gain tax exemption up to 1 lakh that's available to him. In fact, we are closing in on the close of this financial year, so it might be worthwhile for him to consider splitting his exit between this financial year and the next financial year, in case he has a sizable capital gains accumulated in his investment, so that again he can benefit from that 1 lakh rupee capital gains tax exemption across 2 years. So those are broadly the considerations that he should keep in mind while switching out.
Okay, so Rajdeep, if you finally decide to withdraw, then as Ashutosh says, this probably is a good time, as you have an option of splitting the withdrawal in 2 financial years, which will help you save on taxes. Now, Sachindra Yadav has kept 30% of his money in cash, waiting for the bull run to run out of steam. So should he, invest that in short-term bond funds?
Well, first I like to point out, and it's a slightly tangential point and not exactly what he's asked for, but I'll suggest him to devise some objective rule for himself for the way he would want to deploy this cash allocation back in the markets. Because a lot of times what happens is initially an investor is willing to wait patiently in a bull run, but if the momentum continues, then he's increasingly faced with a pressure of losing out on the gains, and there may come a point when eventually he gives in and redeploys that money, only to later figure out that he ended up investing closer to the peak, and eventually, is worse off than he would have been had he continued to be invested all through this while. Uh, so I'll highly recommend him to frame some kind of an objective rule for himself, something like I would deploy a certain percentage of this portion in the markets at every certain percentage fall in the markets, or some other such objective rule which guides him to objectively deploy this money rather than being too guided by a judgment or a call on the markets. So that's one. Now, coming to whether he should deploy this money in short duration funds, well, I would advise against it. That's because the money that you would need to call upon at a very short notice should ideally be parked in liquid funds, or perhaps even ultra short duration funds, but not short duration funds, because over short periods of time, these funds can experience a certain degree of volatility, which may not suit the purpose for which he's looking to deploy this money. In fact, we've just experienced volatility among short duration funds in the last week, when these funds registered a fall of the magnitude of about 0.4 to 0.5%. And in fact, a lot of investors have been writing to us worried about these negative returns generated by short duration funds. So I'll suggest that for this kind of an allocation, which he may just need to call upon at a very short notice if the markets were to start falling, it is desirable that he keeps them in relatively safer and more liquid funds, which are the liquid or the ultra short duration funds.
Siddhartha Roy Chaudhary wants to know, when one switches from one scheme to another under the same fund house, are there any tax implications since the investor doesn't receive anything in hand?
Well, yes, if you switch out from a fund and reinvest in another fund of the same fund house, even then the same capital gains tax rules are applicable as are in case of a redemption. Not only that, in fact, if you were to switch your investments between the regular and the direct plan of the same fund, even then the same capital gains tax laws are applicable. So you need to be mindful of that while planning your switch. That's one. But he made an interesting point about the money not coming into his hand. So why the capital gains tax applicability? While the rules right now are like that, but in fact we also have a tax sheltered account on our wish list for long, where as long as the money remains within that umbrella account, an investor need not pay any capital gains tax on any switches from one fund to another within that account. Those investments may even be in stocks. Somewhat similar flexibility one has in the NPS tier 1 account, where one can switch between the plan sponsors. There is a fair degree of flexibility available there for an investor to switch from one plan sponsor to the other without invoking any capital gains tax liability. But thus far, there is no such account or no such provision available in case of mutual funds. But we'd love to see some such account, a tax sheltered account, being introduced in India at some point in time.
All right, Dr. O.P. Gupta has recently invested a large amount in low duration and short duration funds for 2 to 3 years, but their NAVs have started falling on daily basis. So he wants to know two things. One, what's the reason for this fall? And secondly, should he redeem?
Well, yes, the negative returns reported by debt funds over the last week has bothered a lot of investors who've been writing to us asking about what should they do about it. Well, first of all, this fall has been driven by market-wide factors. So there was a 14-day reverse repo operation that the RBI announced, which was somewhat unexpected by the markets, and that's why the bond markets reacted a little sharply to that. And therefore there was a spike in the yields of the bonds, and whenever the yields rise, the bond prices fall, and which in turn reflects in the falling NAVs of the funds, and that's why these funds have reported negative returns. As a phenomenon, this has not been limited to low duration or short duration funds, but virtually all categories of debt funds other than liquid and overnight funds experienced negative returns of varying magnitudes over the last week. So I'd say, given his time horizon of 2 to 3 years, he should not be too worried about these interim ups and downs, which are bound to hit these funds, at different points in time. Or over a 2 to 3 year horizon, the kind of categories that he's chosen appear to be suitable enough. So he should not worry too much about this volatility. But having said that, I like to point out to him that these are the categories where some funds historically have pursued high yield strategies, where they've taken notable exposures to bonds of lower credit quality to pursue higher returns. So that is an aspect where he would need to exercise selectivity and perhaps avoid investing in funds which assume too much of credit risk. And other than that, it should be fine.
The next query has been sent in by Birendra Sharma, who wants to know, should he redeem his investment from a small cap fund now because market has risen too much?
Well, in fact, a lot of equity market outlooks that AMCs have been coming out with these days, some of them do expect small caps to outperform the large caps from a medium to long term horizon. But I'll say he should not be too guided by that. The role of small cap funds in a portfolio is that of a supplementary allocation of, say, not more than 10-15% to boost returns. Because if you look at the long term track record of small cap funds, over longer time frames of say 8 to 10 years or more, they tend to outperform the multi-cap or the large cap funds by a fair margin, and they do that consistently. So from that perspective, they are a good way to bump up your returns of your equity portfolio. But having said that, they are riskier and much more volatile, and that's why it is not desirable to go overboard on those allocations and keep them fairly limited in a supplementary role of say as I said 10 to 15% in your portfolio. So I think he should be guided by that framework and really evaluate in his portfolio if he has a much higher allocation to small cap funds, or if his investment horizon is much lesser than even 8 to 10 years, then he should consider pruning his exposure to these funds.
Onkar Shinde is new to mutual fund investing, and he's been investing in Axis Bluechip and Axis Midcap funds since October 2020. He wants to know if it's necessary to have 4 to 5 funds in his portfolio, or are these funds enough?
Well, there is no hard and fast rule about the number of funds. Generally, we do recommend investors to diversify across funds, but really don't go overboard. And we believe that 4 to 5 funds should be adequate enough in a portfolio. Now, for a small investor who is making contributions of, say, rupees 5,000 a month, maybe just a couple of funds are good enough. But someone who is investing a much larger sum every month, uh, can look at building a little more nuanced portfolio and add a few more funds. But having said that, what I note about his investments is that both of his funds belong to the Axis mutual fund house. So at an AMC level, he should consider diversifying a little bit. Despite the fact that these two funds, one is a large cap fund and one is a mid cap fund, and therefore their investment universe are fairly different, and likely there is not much overlap in the underlying portfolios of these funds. But even then, it is desirable for one to diversify across a few fund houses. That's because despite having very different investment mandates, there are certain commonalities that run within the funds of a fund house, because they have a common equity research team. So they would be commonalities in their equity market outlook, their outlook on different sectors, or their stock selection process, or even their investment style. For instance, if you talk about Axis, their equity funds, they generally tend to prefer running high conviction portfolios with very limited number of stock holdings. So they tend to be more concentrated than many other funds in their categories. Also, they have a very sharp focus on the quality of stocks that they own, and they don't mind paying a premium for that. And that's why you would notice that a lot of their funds have portfolios which are fairly richly valued on the PE ratio metric. Their funds happen to have the highest PE ratios in their respective categories. So the broad point that I'm trying to make is that there are certain commonalities that run across different funds of the same fund house, and if their investment style goes out of favor, which very likely can happen at certain points in time, then if you're only invested with one fund house, then the impact would be felt across all your investments. So it's always desirable to spread your investments across a few fund houses. So from that perspective, it is desirable that he adds one or two funds to diversify.
Now, Gopalakrishnan asks, why is Kotak Flexicap fund appearing as very high on Riskometer? The earlier fund, Kotak Standard Multicap, was appearing as moderately high on Riskometer, so he wants to know the reason for this.
Well, this has nothing to do with the shift of the fund from the multi-cap to the flexi-cap category, or a change in its name from the Kotak Standard Multi-Cap to Kotak Flexi-Cap fund. In fact, this change has not even put into effect as of now. In case of this fund, this change would come into effect from 1st of February. So this change has nothing to do with this. The underlying reason for the shift in its risk grading on the riskometer is that the new methodology for risk grading as prescribed by SEBI has kicked in from the start of January, and the first riskometer gradings as per the new methodology has now been released. Now, what used to happen earlier was that every fund category was assigned a certain risk grade, and all funds within that category used to carry the same risk grade. But as per the new revised methodology, the risk grade is determined by the underlying portfolio holdings and not by virtue of membership to a particular category of funds. In case of equity funds, the underlying factors that determine the risk grade are the market capitalization, so the proportion of assets which is invested in different market cap segments, the large caps, the mid caps, and the small caps. Then what is the liquidity of the underlying portfolio? And the third is the impact cost that the underlying holdings are likely to have because of buying and selling in those holdings. So these are the factors which determine the risk grade of a fund. Now that the first set of risk grades under the new methodology have been released, the early impressions suggest that there may need to be some tweaks in the methodology, because if you look closely, virtually all equity funds, right from the passively managed Nifty 50 index funds down to high risk funds like sector funds or small cap funds, even aggressive hybrid funds for that matter, are all bunching up in the very high risk grade, which is slightly counterintuitive, because you would expect some degree of distinction between the risk profile of an aggressive hybrid fund or a passively managed large cap index funds versus that of a small cap fund. But as I said, that these are early days, and hopefully once there is more clarity about the underlying methodology and really any flaws that are there, then hopefully there would be some tweaks made to make this new riskometer more useful for investors. So broadly, I'd say that he should not worry too much about the change in the risk grade. It is not just about this fund, but virtually all its peers have experienced a similar rise in their risk grade.
So no need to worry as of now, Gopalakrishnan. Now, Vinayak Agarwal wants to know what strategy should he follow while investing to create an emergency corpus. Should he invest in liquid funds or ultra short-term funds, as he's looking for good returns in a short term?
Well, the first thing that I like to point out is that for your emergency corpus, the most important or the top criteria should be liquidity and safety of your capital. So returns as a criteria is always secondary. So he should not focus too much on returns, because otherwise he may just end up choosing riskier funds which may not be suitable for this kind of allocation. That's one. Now, liquid funds are ideally the most suitable category among mutual funds for emergency corpus, because they have all the tenets, all the attributes that you need from a fund for this kind of an allocation. But having said that, as I've mentioned earlier, that these days a lot of liquid funds are yielding somewhat similar returns to that of a savings bank account. So some investors wonder what's the merit in giving away the surety of a savings bank account for a liquid fund when the returns are somewhat similar. And this may just continue for another 2-3 quarters at least down the line. And this is in sharp contrast to earlier times when liquid funds could yield meaningfully higher returns over and above your savings bank account, and therefore they made a lot of sense. So for those investors who would like to optimize their returns from this allocation a little bit and who do not mind a slightly higher degree of volatility, can consider moving a part of this allocation to ultra short duration funds as well. But for most of the other investors, liquid funds or even their bank account can continue to be a preferred choice for keeping this allocation.
Rohit Kumar asks, is it advisable for an investor who's been investing in mutual funds for the last 5 years to invest in new fund offers? He's often approached by relationship managers to switch to an NFO, he says.
Well, new fund offers make sense only if they have some unique offering which fulfills an investment need which existing products or existing mutual fund schemes are unable to. And obviously, such NFOs are very rare to come about. So for all practical purposes, by and large, one should stick with the old and the more established funds and avoid investing in NFOs. And while deciding whether there is any specific or a unique investment need that is getting fulfilled by the NFO, one should really not be guided, or one should look beyond the marketing narrative, which would make you believe that this product is indispensable for your portfolio. Now, talking about relationship managers, just bear in mind that when they ask you to switch from an existing fund to an NFO, more often than not, it ends up serving their interests more than yours. You should really avoid the temptation to switch from an established fund to an NFO. The only 2-3 reasons that you should consider exiting from your existing fund is one, when it has turned into a sustained underperformer and you're looking for better alternatives. Second is that there are some fundamental shifts in the investment style or the investment pattern of the fund, which makes it unsuitable for you, and you want to move out of it. The third is that you need the money, or your investment needs themselves have changed, and therefore you need to move to a more suitable product. And finally, you may also consider exiting from a fund for the purpose of rebalancing and restoring your asset allocation. So be guided by these needs to consider exiting from a fund.
All right, now Shankar wants to know how safe are liquid funds to park his emergency reserve funds instead of savings bank account. Secondly, he has SRPs in equity funds, and in some funds, the corpus has grown beyond rupees 10 lakh. So should he continue with his SIP in these funds, or do you suggest a cap on the corpus in a single fund?
Well, to answer his first question first, liquid funds are generally suitable to park your emergency corpus. Of course, they don't provide any guarantees of any kind, but the risk of losing your capital is fairly negligible. And as I've said earlier, these days their returns are somewhat similar to what you get from a savings bank account. And some investors have been wondering, and they ask us, what's the merit of investing in a liquid fund when the returns that you're getting these days are similar to a bank account. So that's something that you have to be mindful of. And this trend, as I said, that may just continue for a few more quarters before liquid funds start yielding some extra returns over and above a savings bank account. So that's one. Now, coming to the second part of his question, about switching out of a fund or reducing allocations, well, I would suggest that he should not be guided by a specific sum in rupee terms, but he should be guided by the percentage allocation of a fund in his overall portfolio. So for funds which are in a core holding role, so funds like large cap funds or multi-cap funds, the allocation of a single fund can be well to the tune of 30-35% in a portfolio, while funds which are more suitable for a supplementary role in the portfolio, the likes of mid-cap funds and the small cap funds, there one should aim to have an allocation in a single fund of about 10-15%. So he can be guided by this framework. And if he thinks that some funds are significantly breaching these kind of limits, then he can consider balancing things out a little bit, and that he can do without really redeeming these funds, but simply by altering the incremental SIPs.
Okay, Rajwant Peer Kohli asks, in my investments tool on value research online, How often are the details uploaded or synchronized with AMCs? He says he's noticed that one of his investments is not reflecting the updated status.
Well, for the performance measures, those are updated on a daily basis. So for mutual funds, the performance related metrics are updated typically by 11 p.m. in the night after the mutual funds have released the updated NAVs. In case of stocks, the performance measures are really updated on a live basis during the market hours. Now, as far as our mutual fund ratings are concerned, they are updated in the My Investments tool or anywhere else for that matter on the website on a monthly basis, because we calculate our revised ratings at the end of every month. And similarly, the portfolio related metrics of funds are again updated on a monthly frequency, typically towards the end of the first week of the month, when mutual fund companies release the new portfolio disclosures of their mutual funds. So broadly, those are the kind of timelines when these details of the mutual funds get updated in the My Investments tool. Now, regarding the issue that he's facing with a particular investment where the details are not getting updated, I would suggest him to get in touch with our customer support team at help@valueresearchonline.com, and they should be able to speedily resolve his issue. Uh, in the normal circumstances, it is unusual for the details of a mutual fund to not get updated if it continues to be in existence. But as I said, that once he shares the details with our customer support team, they should be able to identify the issue and resolve it speedily.
Now, today's last question has been sent in by Praveen Kumar Singh, who wants to know, how should one compare two or more mutual funds?
Well, I'd suggest he can simply use the fund compare tool at Value Research Online. So from the homepage of our website, if he scrolls down to the VRO tools section and clicks on more tools, the page that opens up, he can select fund compare tool. And on that tools page, he can simply search and select the funds that he wants to compare, and he would get a table of a lot of metrics that compare those two funds. So a lot of metrics on the performance front, short-term returns, long-term returns, SIP returns across different time periods, calendar year returns, and much more. There is a whole host of performance metrics that one can get. A lot of portfolio-related attributes that one can compare funds on. Also, several of risk statistics that are there on one's fingertips. So I'd suggest him to give it a try, and I'm hopeful that he'll like it.
With that, it's a wrap on this episode of Helpline. Thank you, Ashutosh.
Thank you, Ruchira.
Thank you to all our viewers. You can go to VR Helpline on Value Research Online and send us the questions that are stopping you from investing today. Our team will answer them in the upcoming Q&A session. Bye for now.